Let's start here. What we want to do just by basics, the basic uh, the basic elements of financial management here. Some of us, it's our first time to do finance. Some we have been doing finance maybe at undergraduate, or postgraduate, or at other levels. Financial management is an integrated decision-making process concerned with acquiring. So we are talking about the acquisition, acquiring here, managing. So you should manage your finances and financing assets, accomplish the overall goals of the organization. So as management, you've got a very big task of making sure that uh, you are managing, acquiring, financing those assets. For those assets, these are resources owned and controlled by the entity. So which means that as managers, we have got a very task to make sure that our subordinates, especially the accountants and the finance people, are managing the finance accordingly. So we should not be just sit down and say they're experts, but on our own case, we should have a knowledge as business people how those people who have been tasked, how our agents are utilizing those funds or are managing and controlling those funds. So it's very critical to that. Speaking differently, it is concerned with making decisions relating to investment in long-term assets, working capital, financing of assets, and so on. So we are saying it's very critical to understand that we need to understand that we should make decision to investments in long-term assets. Maybe long-term assets such as acquisition of new plants. Then you should maybe invest in maybe in a new acquisition of assets which are critical, maybe in improving the business, expansion of the business, or diversifying into new business whereby you need long-term assets. Working capital, these are day-to-day, these are critical in the day-to-day running of the business. So working capital is very critical. Working capital, we're talking about like our current assets, such as cash in hand, stock, that is inventory, and other items. Financing of assets, they need to be financed and so on. So that is very, very, very critical for us as managers to have the understanding of how I'm going to invest into the long-term assets and how I'm going to utilize our working capital, how I'm going to finance these assets and so on. So that is very, very critical. So here we've got some important items here which are very critical, which are supposed to know. That is investment decisions. That's what we're talking about. That finance decision, dividend decision, function of financial management. Those are some of the critical components which are supposed to understand in the finance department, finance managers. We need to have a knowledge on that. Let's look on again. Financial management capacity is a cornerstone of organization excellence. Why? Because if the organization is not doing well, if we find that the organization has got a poor financial management, that organization is likely to be there's no going concern. The organization can collapse and the organization can go into liquidation because there is a poor financial management, because the finances, the funds of the business, they are the blood of the business, they're the backbone of the business. So if the business lacks that, those funds becomes a very big problem. Financial management pervades the whole organization as management decision almost always have financial implications. So we find out when you come up with any decision, you need finance. If if there are no finance, it becomes a very big problem. So that is critical. Let's go on. We are talking about again, let's go on so that people they understand what we mean. So we're saying again, financial management entails planning for the future or of a person or a business enterprise, ensure positive cash flow and maintenance of assets. Because if the cash flow is negative, it becomes a very big problem. Because the cash flow, we're talking about the movement of cash in a positive direction. So this is very critical. So the maintenance of financial assets, that is very critical again. So it helps. So there is sound financial management. It means the planning for the future is well taken care of and is well considered. The primary concern, go on to the primary concern of financial management is the assessment rather than the techniques of financial quantification. So you assess, then you find out is the team, then you can come up with the corrective measures when necessary, and you can come up with the correct decision, the informed decision based on the financial performance of the business. Then you can make an assessment. Some experts refers financial management as the science of money management. So you need what you understand that I'm talking about the what money management. Hey, all the assets, all those assets of the business, they are supposed to be expressed into a monetary situation. So this is very critical. So we should understand this key concept that all those assets they should be converted into, they should be expressed into monetary items. Then you've got the scope of financial management is our next subtopic. The scope and function of financial management is classified categories. That's the traditional approach and the modern approach. What do we mean traditional approach? According to this approach, the scope of the finance function is restricted to procurement of funds by corporate enterprise to meet their financial needs. The term procurement refers to raising of funds externally as well as the interrelated aspects of raising funds. So that is critical. The term procurement refers to raising of funds externally. If you are borrowing externally, it means maybe you are raising funds maybe from the banks and other well-wishers or other external users, maybe the investors, the capital investors, and so on. So that's the traditional. So you procure what funds meet the other financial needs. That's the traditional what method. Then slide number 8. The interrelated aspects are the institutional arrangement of financial instruments through which funds are raised, and legal and accounting aspects between the firm and its source of funds. So we're talking about the legal and accounting aspects between the firm and its source of funds. So sometimes the legal implication includes the lawyers. They need to have an agreement, a contractual agreement, because they've got an obligation to pay that in the long term or in the near future. So the firm is going to be included sometimes in the legal. The firm and the source of funds. Source of funds sometimes it might be expensive, sometimes it might not be what expensive. So that is very critical. The traditional approach, the resource could be raised from the combination of available resources. So the available resources again can be used to raise what the funds are needed for the business. Then let's go on to the limitation of traditional approach. This approach is confirmed to the procurement of funds only. So it means it is only concerned about the procurement. When you are procuring funds, it means what you need, you are sourcing funds. So when you are sourcing funds here, it fails to consider an important aspects of allocation of funds. So that is the weakness. Allocation of funds, how those funds are going to be allocated to different departments or to different sections of the organization. So it is very critical for the management to make sure that these funds are well distributed, are well allocated where there is a need. or where there is a requirement, or when the organization is going to produce, make production, therefore increase profit or maximizing revenues. So it is with only outside, i.e. investors and investment bankers. So I'm saying but it's expensive. Because if you are dealing with investors and banks, there's a probability that you are going to pay tax, because you are going to pay interest, pain of interest, pain of interest. That is a it's a finance cost on its own. When you are paying interest, generally it becomes a finance cost. So it's very, very, very expensive sometimes. So when you're paying interest, it becomes a finance cost. Then the internal decision making is completely ignored to this approach. That's the problem. So want to come up with the internal decision which is made by the management and other relevant stakeholders in the organization who are responsible for day-to-day running of the business. The traditional approach fails to consider the problems involved in working capital management. It failed to consider the problems involved in working capital management. The traditional approach neglected the issue relating the allocation and management of funds and failed to make financial decisions. That was the problem. That this is a very, very crucial point. While the traditional approach was there, but on its own, it did not take care of what it neglected the the issue relating to the allocation and management of funds and failed to make financial decision. Okay, so which means that on this case, it means it is very difficult when you are using the traditional approach to make a sound decision and to make relating the allocation of management of funds. So it becomes very difficult for an entity or for the management to make a proper financial decision, because this one is mainly concentrated on the outsourcing of what of funds outside the external stakeholders. That's its major objective. That it should acquire money, those funds from the external. Let's look on the modern approach. Modern approach is an analytical way of looking into financial problems of the firm. This one means there is analysis that is different with the traditional one. However, in this approach, the finance function covers both acquisition of funds and allocation. But in the traditional, find out that it was only covering the acquisition of funds externally. But here, as well as allocation of funds to various users. So that is very critical. Financial management is concerned with the issues involved in raising of funds and efficiency and wise allocation of funds. So I saying financial management is concerned with the issue involved in raising of funds and efficiency in the wise allocation of funds. So that is very critical here. Say in both of the modern world, it means raising of funds, the efficient and wise allocation of funds. That is very critical. That you need to have what? To have the efficient and wise allocation of funds. Then the main contents of modern approach, you should understand this. How large should an enterprise be and how far it should grow? Because there is a growth model whereby the firm should grow. If the firm does not grow, that is not health for that organization. But a firm will expect it to have a growth rate, a growth, so that at least it expands, so that at least it can have a bigger market share, so that at least it can have, contribute much more revenues itself and the economy at large. In what form should it hold its assets? In what form should it hold its assets? Financial management is concerned with finding answer to above problems. The assets, sometimes other assets are being, some assets are being held as form of monetary farm, of monetary, some in terms of maybe like Zimbabwe, some of the funds might be assets and in terms of gold, coins. So that's very critical. Some they can acquire long-term assets such as building, land and building. So they invest in that land and building. They expect that land and building to appreciate in value. So it's very, very critical on that. Then there are 5 basic components of financial management frameworks, which are planning and analysis, asset and liability management, reporting, transaction process, and control. When you are planning and analysis, when you're planning for the future, when you're analyzing, you try to come up the existing data or the existing financial information, then you come up with with an informed decision, which is very crucial for the company. Asset and liability management, how are you going to manage your assets? Assets, we are talking about both current and non-current assets. We are talking about the inventory, we are talking about the cash, we are talking about the long term, like motor vehicle, building, and so on. Liability, if you are owing, you've got creditors. How are you going to manage your creditors? That is very critical. How are you going to manage you've got a bank overdraft? How are you going to manage your bank overdraft or your loan? Reporting, you need to report the information in a relevant and liability manner. Then you report to other stakeholders. Transaction processing, when you are processing a transaction, you incur some costs. So it's very critical to understand that. Control, when you are controlling something, because they found a problem, so you need to control it. If you should find out what can be done to take effective measures, that is very critical. Then it's very, very critical. Okay, let's just sum up this one. When you are control here, transaction process, we have got asset and liability management, reporting, planning and analysis. So you start by planning and analysis here at this level, then asset and liability management, then you report, then transaction process, then control is the overall at the end in a triangle. So you start at this level, then you go down by down. So that is very important. Very, very, very critical to understand these basics. But at least you understand the reason why you should there are key basics. Why you should be the champion of financial management, and why it's important for you to have a sound financial management. Financial management is concerned with procurement and utilization of funds in a proper way. It is important because of the following advantages. It helps in obtaining sufficient funds at a minimum cost. So it means that at a minimum cost, and what don't have any proper financial management. People, they don't allow you to borrow. They can not lend you. So you need to understand that you need to have what efficient method of running your finance. Effective utilization of funds. The funds need to what effectively utilize. Try to generate sufficient profit to finance expansion and modernization of the enterprise. So that is why I'm saying for expansion, that's very critical. Ensure safety of funds through creation of reserves, reinvestment of profit. So which means that you can, that's the other method of taking care of, that is the profit. So if they are profit, you can take that profit and create some reserves here for investment. That is very critical. Instead of using all of sharing finance through dividends, finance dividend payment, the company can decide to make sure that there's the profit allowed back into the business so that the business can expand. That is very critical. So these are very key elements, major decisions which finance managers take. Investment decision, usually this one includes acquisition of assets here. That is acquisition of assets, especially long term. That is acquisition of assets. Finance decision. What do you want to finance? What is to raise funds? What to raise funds? Raise funds. That is very critical. Dividend decision. That is rewarding the investors. Because these people who have invested their money, they want to be rewarded. Rewarding investors. So that is very critical. You need to reward the investors. Say here, raising fund. Okay, for dividend decision, you are saying you want to reward the investors through the payment of what dividends. So this is very critical. So if the company's got profit, it might decide whether that profit should be invested into the business again, or it should be paying dividend. So depending on the organization's what the goal. But it is very wise for the organization to invest, make an investment decision. Directly the business can what expand. Okay, I was just explaining on this one. Then you can go through the decision leads to the careful selection of assets in which funds will be invested by the firm. It involves buying, holding, reducing, replacing, selling, and so that's the careful of what assets which need to what raising of finance which need to be catered for. So that is very critical. Then we go on to finance the acquisition of funds needed for support long-term investment, like what I've explained in the previous slide. That you need to the business make sure that there is acquisition of what are needed. While taking the decision, financial management weighs the advantage and disadvantage of different sources of finance. Some sources of finance they are very expensive. For example, if you borrow money from a bank, the bank interest might be very higher. So they make sure that they make the organization should come up with staff who understand or who can able to appreciate the importance of reducing cost. So the business can either finance from its shareholder funds, can converted into equity share capital, preferred share capital. That's its own source other than going outside to go and what for. Borrow from outside, they borrow funds like ventures and loan from financial institution. So if you want to borrow outside, you go and get a loan from the bank. Maybe you can go to CPZ or you can go to Agribank or you go back to anywhere. Then you get a loan if they agree. The dangers, the long-term debt with in danger. Okay. Dividend decision. Decision relates to the appropriate of profit earned. The two major alternatives are to retain profit earned and to distribute these profits to shareholders. While declaring dividend, a large number of considerations are kept in mind, such as trend of earnings, stability in dividends, trend of share market price, the requirement of funds for future growth, the cash flow situation, the restriction under Company Act. So this one you can what when consider paying dividends, what are the factors? We need to understand these factors, such as strength of earnings, stability in dividends, share market prices. Sometimes we just pay dividends, find out the company can crumble. Okay. Then these are the three-leg true analog broad classification of decision activities: investment, dividend decision, and financing decision. Those are the key objectives of the company. why the company might need that, and this company will need to make sure that it makes decision on the following before it allocates its funds. Dividend decision to pay its investors, investment decision, acquisition of assets, financing decision, that is the procurement of the which are required. Okay. Before we go further, can we have some discussion, some questions here? Before we go further. Hello, colleagues. When you participate, I have given the introduction so that we also take part during this lesson.
Hello, Doc.
Hello,
Hello, how are you?
I'm fine.
I would like to note that I've understood the traditional approach that the corporate will procure funds from externally, but I'm not quite sure on the modern approach. Does the firm procure funds from the inside, or how does that actually work on the modern approach?
Okay, thank you for the question. We're saying in the modern approach, the firm it will be doing, it will be involved in both the acquisition of those funds, maybe internally or externally, and also the firm will also trying to make sure that these funds are allocated to various uses, and also those funds are allocated efficiently. There is a much more use of modern techniques such as financial modeling system, so that the firm will raise funds, which is not going to be a burden. The analysis. So this involves to come here this slide number. That is slide number what? Number 11, which says acquisition of funds as well as allocation of funds to various users. And also there is efficient and wise allocation of funds, but there is analytical ways of financial problems of the firm. So the firm is to come up with is to analyze how these funds are going to be utilized and what is the problem and what is to be done.
Thank you so much. I got that now.
Thank you for the question. Any other questions? Any other questions so that we can go together? Well, this is critical because we are going to apply most of these concepts into other topics, into other areas of financial management. Let's go on to the next objectives or goals of financial management. This is very critical. You might find out that at the end of the day, people they might not understand this critical to say what is the objectives or goals of financial management. The objectives, that is what you want to achieve. What are your main reasons for financial management are? One, profit maximization. A company needs more profit. Anyone in the business needs to make profit. That's the major aim of getting the business, is to make profit. So the objective of financial management is to make profit. Profit maximization means you need a higher what? A higher profit here. Because anyone will need more profit. That's critical. Then here, return maximization. Return maximization. If you have invested your money, you expect a what? A return, a higher return. You expect something. An investor, if the investor invested his or her money, he or she will expect to get something at the end of the day. If you are in the business of selling tomatoes, you expect a return at the end of the day. Then we go to wealth maximization. Business need wealth maximization so that you increase the wealth of maximization, the wealth of the investors. Those who have invested their money, their aim is to get more funds so that they become what? They become wealth. Okay. Maximization of profits is generally regarded as the main objective of the business. So this is the objective of the business. Sometimes find out that the examiner might ask you a question to say, maybe a case study. Then they say, related to that above case study, what is the main aim of the business? You might find out that it depends with the enterprise. Some enterprise, like a public institution, such as a hospital. A hospital, its main objective might not be for profit maximization, but it's there for making sure that it provides right service. So it's not worried about too much of profit maximization. That is the hospital. And the shareholders, usually is the public. The shareholder returns is not that catered for. But maybe it can be for what? Oh, people might be worried about maybe raising revenues, so that can able to fund some of the activities the hospital. Return maximization under financial management is safeguard the economic interests of the person who are directly or indirectly connected with the company, shareholders, creditors, and employees. Shareholders, those who have invested their monies, their funds. Creditors are those individuals who have provided us with goods for selling. For example, the creditors, they can provide us with inventory, with stock, so that we can pay them after we also sell our goods to the customers. Or the banking overdraft, those are creditors, short-term loan. Employees, they are worried because if the organization is not doing well, the employees means they will be jobless in the next the future because of the ongoing concern. So the ongoing concern is no longer there. The organization can shut down its doors anytime. Both maximization of profit is regarded as the proper objective of the firm, but it's not as inclusive as goal as of maximizing its value to its shareholder. Some companies, they will be trying to have a good corporate governance, social responsibility, and so on, so that this company is what, so that this company it takes advantage of that, so that this company might have a firm, might be popular, might have a big name. For example, if a company is not being running, the management is not running that company well, the company can drop its value shares because the people they lose confidence in that. So the value of the company can be maximized if the company may be being run and being controlled by a sound management system. So that is very critical. Then here we have got function of financial management can be divided into two groups. Those are executive or managerial functions, incidental or routine functions. Managerial functions, those are on the top. So you find out that we have discussed some of those things, such as the financial forecasting, investment decision, management of cash, management of income, conducting. That is some of the executive functions which should be done. So both they involve financial investment decision what making. What you want to do, want to go to the next slide. Before go to the next slide, the next topic, capital budgeting. You have got any question on the objectives of financial management? Objectives of the financial management. Any question? Hello? Any question?
This is clear, Doc.
Hello? Can you proceed?
Yes, we can proceed. This is clear.
Okay, thank you so much. Let's go on to the other very important topics. Topic we're talking about to say the organization should be involved in the investment. So because of that, how do you invest? Most of the time you can invest into capital. Capital that we are talking about, the long-term assets, that's the capitalization. They invest the funds in the assets which will either improve the entity or the business performance, or you are trying to add important assets in the business so that you expand your business. That is usually what capital budgeting. Or trying to replace the old one with the new assets which are effective and efficient, because you cannot continue with the old assets which are giving you problems. So you find out that because of that, usually we are talking about those projects which add to the firm's value, and as such, it is perhaps that the most important task faced by financial managers and their staff. So we are saying capital budgeting. There is you add to identify those projects which add the firm's value, and as such, it is perhaps the most important task faced by the financial managers and their staff. You find out that when you are a manager, sometimes you might have many projects. So you should come up with a sound decision. And to select, should make sure that as a good manager, can you select the project which is going to maximize wealth or maximize profit, or which can make that the returns of the investors will be realized. So it is very critical to note that. That's why we are saying that managers use to identify those products that aid to the firm's value, and as such, it is perhaps the most important task faced by financial managers and their staff. The firm's capital budget decision defines its strategic direction, because moves into a new product, sales, or markets must be preceded by capital expenditures. Second, the results of capital budgeting decision continue for many years, reducing flexibility. So that is very important. So we need to understand that strategic direction. We're not talking about the strategic, we're talking about the long-term goal of the organization. What is the organization wants to achieve in the near future, or in the next more than 5 years or 10 years? That is the long term. That's the strategic. Tactical, that is short term. So it's very important to understand that. Because one, we are saying the result of capital budgeting decision continue for many reducing flexibility. So it should be very strong because usually it involves long like sum of funds. So what is supposed to be done, that you need to have a sound, proper management of financial. Third, poor capital budgeting can have serious financial consequences. You need to understand this one, that poor financial budgeting can have a serious, very, very, very serious financial consequences. If the firm investment too much, it will waste investors' capital on excess capacity. So you need to be very careful with this poor capital budgeting, serious financial consequences. On the other hand, if it does not invest enough, its equipment and computers, software may not be sufficiently modern and able to produce competitively. There's a competition these days because of the technological advancement. So you need to be very careful when you're, let's say you're in a cell phone manufacturer. You need to be very careful. Look like if you look like Nokia used to be one of the top brands, one of the best cell phone producers, mobile phone producer in the world. But nowadays, Nokia is not longer competing as it used to be with other giants such as iPhone, Apple, Samsung, and so on, because maybe the organization did not invest sufficiently into the modern techniques, modern technology. So you need to make sure that the management make sure that they apply good financial management, so that the budgeting system should be a sound. Can you make sure that you invest your resources into the projects which are going to make you competent, which are going to maximize profits, which are going to maximize wealth, which are going to make sure that the shareholders return or the stakeholders return is realized. So it's very, very, very critical. If it is inadequate capacity, it may lose market share to rival firms. Like what I was saying to say, for example, we find out that Nokia lost its market share to its rival firms such as Samsung, such as iPhone, Huawei of China, and other mobile operators, mobile manufacturers. And regaining lost customer requires heavy selling expenses, because selling expenses need to market for you to make sure that you regain those lost customers. Price reduction or product improvements, all of which are costly, because you want to re-penetrate into the market. So what it means that if you are not good, if your financial management is not that good, you might face those problems, because they are going to have, and it's very costly to restart. Like for now, for Nokia, even if they decided to come up with new technology, from Nokia to beat Samsung, it's not going to be easy, or to beat iPhone or Apple. It means it's going to involve lots of marketing, lots of advertisement, and the reduction of cost for price penetration and so on. So this is very critical, that we need to make sure that our financial, our capital budgeting is being taken seriously. Otherwise, the company can decline. Otherwise, the company can run into liquidation. The ongoing concern of the company might be in jeopardy. Okay, let's go on to this one, capital decision rules. Capital decision rules, but before we go that, let me look on this one. Yeah, there are some projects which can be done concurrently, but there are some projects which cannot be done concurrently. For example, let's look on this type of projects. Independent project is one which acceptance or rejection does not directly eliminate other projects from consideration. E.g., a firm may want to install a new telephone communication system in its headquarters. and replace a printing press at approximately the same time. In the absence of financial constraints, both projects could be adopted if they meet maximum investment criteria. What we are saying here, we are saying acceptance or rejections. If those projects, one project does not directly affect the elimination of the other, but so it's independent because there is no the telephone communication system. If the funds permit, then you can say no. All the projects, what both projects. But there are some projects whereby they're not independent. They are mutually exclusive, which means that one project means the other project cannot be continued. For example, if you want to, there are two. You can say it's either the company should invest into this technology, or from Dubai, or investing into this technology from South Africa. Which means that if you take one method, maybe if you decide to take one from Dubai, it means one from South Africa will not divide, will not implemented. So we are saying that's the one whose acceptance precludes the acceptance of one or more alternative proposal. Since the two mutually exclusive projects have the same capacity to perform the same functions, only one should be chosen. Like what I've said, say if they're in the same line, so you should make sure that maybe choose the project which has got maybe less cost, and the project is going to with the capacity to have higher production, or which has the capacity to produce more. So since two mutually exclusive projects have the same capacity to perform the same functions, only one should be chosen. E.g., VW was deciding whether it should locate a new assembly plant in South Africa or Zimbabwe ultimately. So South Africa, and this precluded the Zimbabwean alternative. So that's mutually exclusive. To say the occurrence of one project, it means it will preclude the other project. Then we have got the contingent independent. It says some of the projects find out the adoption is dependent on the one which acceptance is dependent on the adoption. Say if you adopt this one, it means this one cannot work in isolation. It means this they work hand in glove. So it means here we need to make sure that at all costs all those projects should be adopted. Because if the one is not there, the other projects might be useless, might not be working. E.g., the installment of pollution control equipment in a new factory is contingent upon the acceptance of new factory plant as a desirable investment. Because you cannot have the pollution control equipment without the new factory plant. When a firm is considering contingent project, it is best to consider all projects that are dependent on one another and treat them as a single project for purpose of evaluation. That's very critical. They need to make sure that they are single for the single project for the purpose of evaluation. Any other queries? We'll go further about these projects. Any other queries? Any other queries? Okay, let's go on to the next area. Capital budget decision rules. There are 6 key methods I used to rank projects and to decide whether or not they should be accepted. One, we've got a payback period. Want to find out how many years or how many months or how many hours or how many minutes are going to take to pay back the capital borrowed from the bank or the capital invested. So the shorter the period of paying back, the more likely the project is going to be accepted. So if you're going to accept it with a mutually exclusive, it means if you are using the payback period, you are going to take the one with shorter period. Discount and payback, here you are using the discounting factor here to make sure that the discounting factor, so that at least by discounting the fund, because the cost of capital should be included. The NPV, net present value, are talking the present value of the what or of that given project. Usually, we want the current money which we are supposed to have, like the net profit, but in discounted form because of the cost of capital. Internal rate of return. This one we are talking about whereby we are saying the rate of return is now at the cost of capital which is needed, the cost of capital which is required for the company to start making what, to start gaining something. Modified internal rate, then profitability index. We will look on this on the practical. Okay. What we want to do here, we should have some calculators, that at least we do calculations here. Need to have some calculators, so that at least we do some calculators. I think I preached for a long time, for the last nearly 1 hour. Can I have somebody read this question so that at least you can be able to understand these techniques? Who can read this question? Any volunteer? Class, any volunteer?
Okay, I can read, Doc.
Yes.
All techniques with NPV profile, mutually exclusive projects. Pitch Industries is in the process of choosing the better of two equal risk. Mutually exclusive capital expenditure projects, M and N. The relevant cash flows for each project are shown in the following table. The firm's cost of capital is 14%. Then there's the presentation of project M and project N. Initial investment for project M, 20,500, and for project N, 27,000. Then below there's year and cash inflows. Year 1, 10,000 for project M, then 11,000 for project N. Year 2, 10,000 for project M, then 10,000 for project N. Year 3, 10,000 for project M, 9,000 for project N. Year 4, 10,000 for project M and 8,000 for project N. The first part, calculate each project's payback period. Can I continue?
Yes, you can continue.
Okay, part B, calculate the net present value for each project. Part C, calculate the internal rate of return for each project. Then part D, summarize the preference dictated by each measure you calculated and indicate which project you would recommend. Explain why. Then part E, draw the net present value profiles for these projects on the same set of axes and explain the circumstances under which a conflict of rankings might exist.
Okay,
I'm
thank
done.
you. Thank you. I will try to quickly explain. Thank you so much for the help and for reading. We are saying this project, the initial investment, that is $28,500 each for M and $27,000 for N. In the finance, there is outflow of money. This way outflow. Inflow, it means you are receiving. Cost of capital, that's the interest which you are going to pay to the banks or to where you borrowed the money. That is the cost of capital, which they say is 14%. So they are saying calculate each project's payback period. They are saying how many years or how many months or how many seconds are you going to take for you to return for the project B to return 28,500. Project N, again the same thing. How many months or how many years are needed for project N to generate revenues which are going to cover up 27,000. So what we do, we should make sure that you understand what we mean. NPV, we are discounting these ones, discounting 10%, because you are saying this we are discounting 10,000, because you are saying 10,000 which you receive here, it should be affected by what you should pay interest. That's why we discount it. That's what that is it means. Okay, so if you go to the first question, which is A here, that is the payback period. Payback period is very simple. For example, here, because the cash inflows are the same throughout the period. Period year 1, 10,000, year 2, 10,000, year 3, 10,000, year 4, 10,000. Since here we have got the same amount of cash inflows, this one becomes very simple, because we are saying each year we have got what? Each year we are generating $28,000, $10,000, sorry. So for us to raise 28,000, which means that how many years we need to do this? That's why I find out here, they saying 28,500 divided by 10,000 is 2.85 years. This only works when, if the inflows are the same throughout the period, that you can use this method. If you find out that, for example, in project N, you might find out that the company was generating more revenue at the beginning of the initial year of the operation of the project. It was 11,000 and it declined to 10,000 and declined to 9 and 8. So you cannot use this method to divide, like I said, 28,500 by 10,000. But with regard to this, what we can do here, we can say, we can have a table like this table, whereby you are saying year 1 the inflow was 11,000, then we write 11,000. Year 2 the inflow was 10,000, then we've got 10 plus 11. Cumulative, the word cumulative, it means the cash which you have been received over such a period. For year saying after year 2, we saying the cash inflows in year 1 plus the cash inflows in year 2, that we get 21,000. Then when you are going again to the next, is now the 21,000 plus 9,000, that is 30,000. But want to find out how much did we invest? It was 27,000. 27,000 was invested. So what does the implication means? It means if you have got 27,000 here, which means that here we now at tier 3 we had already arrived at the threshold. So which means that our payback period is 27,000. It lies between 21 and 30,000, which is year 2 and year 3. That lies our 27,000 here. So what do? It means in year 2, between year 2 and year 3, that is there is 27,000 here. So what do we do here? Then we say 2 here plus, then we say 27,000 minus 21 here. Because we arrive at 27,000 here minus 21 divided by the difference between 30 minus 21, which is 9. So 30 minus 21 is what? It's 9. Because we are saying that 27 is between 21 and 30. But what was the difference between the two? The amount of the cumulative, or we can say that is the 27,000 here minus 21. 21, this one divided by 9,000. Then we have got what? Because we are saying 9,000, we are trying to say the 9,000 during the year 3, we are proportionate it throughout the whole period to say, so it means what was the average? And so we are getting 2 plus 6 over 9, which is 2.67. So that is our answer, the payback period. If the period, if the payments are the same, it's very simple. It's very easier. You just take the amount invested, then you divide by the funds inflow per year. Becomes very easy. But on this one, it means you should use this table whereby put the cumulative cash inflows throughout the period. Then you find out to say, okay, this is 27,000 lies between year 2 and year 3. So that is 2 plus that is 6 over 9. Yes. 6, that is 27 minus 21. Because we need 27 here minus 21 divided by 9. The cash inflow for the year. Any question on this technique? Any question? Any question on this technique? Any area which need clarification? Any area which need clarification? Any question? Okay, if you have got any question, let's go to the next one. Then the NPV, net present value. Net present value, we are talking about the revenues, the cash which we generated. We are now going to the net present what? Net present value. So with regard to this, Paulina Can you remove your video? Some of our networks are very poor. Okay, on the NPV here, what we are saying, you need to use tables. Or if you cannot use tables, what do we need to do? Because what we need to discount each and every for each and every year. When it is equal like this, the net present value when it is equal, what you do, you go to your tables, then you have got PVIFA 14% 4 years. You got the tables. On the tables, which are going to get is in the exam, you need to practice them. You find out that you got 14% in 4 years. You get this figure 2,914. Then you say 10,000 times 2,914 minus 28,500. Or I can go line by line. For example, those 10,000 here can come here 10,000, 10,000, 10,000, 10,000 like project N. Then here you discount them. Why are we discount them? We discount them because we say these are the cost of capital. As you go on, if you are owning somebody, owing somebody, it means as time goes on, you pay higher interest. Because interest you will continue to grow with the period, with term factor. Because we're talking about the term value of money. So the cash inflows here, if you go to our topic, to our question, for M is 10, 10, 10, 10. So we should discount this one. But because we're using, they are the same, it was easier because the discounting factor for 2 years and the total, and for the 4 years becomes 10 times 2,9. Then the figure which you get is subtract 28,500, the initial investment. This one, because this is 11,000, this is 10, they are different. So the discount factor for year one, discount factor for year one, that is the factor which you are getting here, 0,877. 0,877. That's the discount factor at 14%. How can we do it? Sometimes who can tell us what can be done? You cannot use, if you don't want to use the table, you want to calculate the discount factor, or you want to calculate this one, the discounting factor. How do we do? These are discounting factors. What do we do it? Well, how do you do it?
Now, maybe I can try.
Yes.
Yeah, you need to have a scientific calculator.
Yes, correct.
All right, so you open a bracket, then you key in 1, then you add the percentage, the cost of capital, which is 14% in decimal form. So it will be plus 0.14. Then you close the brackets. Then you multiply everything with the power minus 1 for the first year.
Can continue.
Yes, 0.1 to the power minus 1. Then you get your discount factor.
Then you get your discounting what?
Factor for the first year. Then for the second year is the same, but what changes the factor? on year 1 it was 1, then in year 2 then you have to put the number 2, then it goes on like that until you get to year number 4.
So 1 divided by, is very simple. You say the formula, if it is 14%, like what he saying, it's 1 divided by 14%, it's 0, it's 0.14. So what do we do? 0.14, we say 0.14 plus what? 1 becomes what? 1.14. So divided by, that's why I send in brackets here. That is 1.114 1.14 to the power, or let's say here, for the sake of others, like this, then to the power what? If it is here 1, then you put 1 to the power 1 here. If it is 2, then you put to the power 2. If you reconcile this, you see it will go on its own. So if we say 1 plus 0.14, that is 1, well, this is 14%, that is 1.14 squared. You get, what's the answer which you get to the power 1 for the first, or let's say to the power 2? What do we get here? Those calculators. What do we get here? It's a very simple. 0.14 is our cost of capital, which is 14%, which is 0.14. Then it's 1 divided 1. This is a formula plus 0.14. This is 2, is number of what? Of years, year 2. If it is year 3, then like what my colleague was saying, he explained it well. If it is year 3 to the power 3, if it is year 4 to the power 4, if it is year 5 to the power 5, year 1 to the power 1. So you see, at the end of the day, you get 0.877, 0.769, 0.675, 0.592. Then you say these cash inflows, 11,000 times this, then you get this one. 10,000 times this, then you get this one. 9,000 times this one, then you get this one. 8,000 times this one, then you get this one. Then at the end of the day, you add this one. You get 28,148 minus initial investment, which is 27,000 from the question. Then you get the net present value. Because sometimes you are given tables in the exam, but because of the pressure of the exam, you might even fail to use the table. So you need to practice. You need to practice. You need to practice to get the counting factors here. It's 1 divided by, in brackets, 1 plus the cost of capital, brackets, to the power number of years, PA2 to the power 2, PA3 to the power 3. Any question on this area here? Any question? Because we don't want people to cry. Sometimes the examiner might give people such a question. You see people failing to come up with anything on the NTV. Anyway, if there is no any question, let's go on to the internal rate of return. Internal rate of return, we are saying we want to find out the cost of what? Of capital, which is required. So here it's simple for this one. For project M, it becomes simple because we are saying that is the we are, because it's the same throughout the whole period. So the project M, that's 28,500 by 10,000 equals to 2,850. Then 2,850 for 4 years. If you look on the table, then you get 2, what? The PVFI at 2,855. Then PVIFI at 15%, then it became 27,798. But don't worry about this. I'll teach you how to do it on using the calculator. This one, they were using the tables, which I suppose also to learn how to use the tables. All right, for project N, the annual cash flow were 11 plus 10 plus 9 plus 8 divided by 4, which means that it was 9. The total amount, average annual cash flow, was 28,000. 38,000 divided by 4. All right. Or the best way you can do here is come up with this amount at 14%. Some, they will say, usually the examiner might be very lenient. So what we need, this one, it gives us a positive NPV. So for us to get a negative NPV, we should increase the cost of capital here. If the cost of capital here 14%, it becomes higher, maybe it becomes 20% or 22%. It means here we are likely to get a negative NPV. Because the cost of capital is high, which means that the entity is paying a lot of interest to its lenders. So at the end of the day, we are going to have a negative. So for you to have a negative NPV, you should make sure that the PV, the cost of capital is high. Because the cost of capital, I saying, that is the amount of the interest which you are paying to the lenders or to the financier of those projects. So the simple way you can do it, you can use the other one, 14%. Then what you can do, you add, maybe sometimes they can say for negative NPV, something 8 plus 8, depending on the percent, become 22%. So if you calculate this 22%, you are going to have a negative NPV. Okay, we look on this, therefore they understand. For example here, this one, they were doing a trial and error until they went to a whereby they were going to get they were going to get a negative here, a negative NPV. But what you can do on your own on this situation to make things very simple for you, if you are given 14% of the cost of capital, try 20% or plus 8. There's a rule of plus 8. 14 plus 8, try 22%. You are going to have a negative a negative NPV. Here there is 17%. There is the 17% here, which means that the 17% can give you a negative a negative for this project. They give you a negative NPV. Then if you calculate, for example, let's say you've calculated here at 14%, this gives you 1,14. Then you go here and calculate another one at 17%, then it gives you 397. That is still okay. Then you apply what you call an interpolation formula. An interpolation formula, which is the formula which we use for calculating our IRR, the interpolation formula. I'll share with you that formula so that you understand how do we do it. sometimes the examiner in the examination might give you that formula so that people they what, so that people they will use it. That formula, I will explain to it the intercorrelation formula which you are supposed to use, so that at least you can able to calculate the internal rate of return. Who have an idea of that formula? I understand one of my friends here has got a very brilliant ideas.
I can try again. Okay, the formula is the percentage that gives you a positive NPV plus a cash flow that we've, the positive cash flow that we have obtained from the percentage that we have given you a positive NPV, or over the same cash flow that has given you a positive NPV minus a negative cash flow that we have obtained from a percentage that have given you a negative NPV. So if you work out that positive cash flow over positive cash flow minus, then you add the two numbers as on the denominator, then you divide them with that numerator, then you add the fraction to the percentage that has given you an NPV positive, then you get your IRR.
Yeah, like what he's saying here, like what your friend is saying. Let's see, we go on to this. Here, we have got the formula here. Don't worry about this one, because usually you might not face such question like this. Usually you don't examine those questions, but it's for your ideas to understand. He is saying there is a present value which will give you a positive NPV. In this instance, let's say 16%. Then there is a present value which will give you a negative NPV, which is what? 17%. Are we together? Are we together on this one?
Yes, we are following.
You're following, and
Yes.
Following.
so what you need to understand here, what does the formula works like? What my friend is saying. He's saying what I want to do, want to find the cost of capital which is required by the ended. That is in terms of what? Of rate of return. So here we have got and here again we have got the positive NPV, and here we've got a negative NPV. Do you understand? So you don't just think that maybe you are going to what? You are going to do some miracles or to just do a guesswork. But what you need to do is to understand, to pick the correct figures at the right time. Say which figure I'm supposing to use here, which figure I'm supposing to apply. That is very critical. That is very, very, very critical. Because some people, they don't know what do we mean by the negative NPV, net present value. They don't understand what do we mean. They think, usually if the cost of capital becomes high, becomes a very, very big problem for the organization. Why? Because if it is like that, it means the company is paying more interest. Once you're paying more interest, it becomes a very big problem. And if you pay more interest, which means that the organization's funds as managers, they're in trouble, because it means you are paying lots of money. So that we are saying to say the company, before start a project, you should compare the two projects. Then you find out which project is given, because the required rate of internal the IRR, internal rate of our capital, usually it should be very higher. Our return should be higher than what we are supposed to pay to outsiders. But if they are not high, it means we are going to get the money to pay. It becomes a very big what? That is a very, very big problem for us. So usually don't worry about the formula, but my friend was saying to help you. But what you need to understand is that the company on its own should make sure that the internal rate of return it should be what? It should be higher than the cost of capital. Because if the internal rate of return is lower, how are you going to get money, pay the interest? It becomes a very big problem. So at this level, we don't want people to get too much into numbers, though some figures might be required. But we are trying to make sure that people they know what do we mean by that. So if they are recommending here, they are saying project N is recommended because it is a shorter payback period. If you look here, for us managers, what we are not only what about numbers. If you check here, the project A 2.85 years. Then these are two projects. The other project that is got 2.85 years. This is my case here. 2.85 years and the other 2.657 years. So which means that you prepare a project which is going to be paid. So this project N might be preferred on the payback using the payback period, because you are going to pay this one in a shorter period than the project M, which you are going to pay back after 2.85 years. So we pay this one. Then again, we can come to NPV. NPV here is 640 for project M, and here it's 1148 for project N. So usually we prefer the project N, which has got a higher NPV. So which means that N is getting advantage over what? Over M, because they are trying to use all different aspects. They are trying to make sure that they are doing a due diligence before you take the start the project. So you find out that this one 1148 is greater than 640. So we would prepare the project what this the project N again. Then you come here again to the RR, which I say don't worry about this one. You find out that at the end of the day, the RRR, the N again is got 16%. This one was 15% internal rate of what? Of return. Though all this internal rate of return, they are greater than 14% the cost of capital. So if you are explaining, you should understand that. Though the cost of capital is 14%, though project M, both project M and project N, they've got a higher cost of capital than it's got less cost of capital than internal rate of return. But the internal rate of return is 15% compared to 14%, which is commendable. Because internal rate of return, we are saying the company can able to generate what? To generate revenues at 15%, getting the rate of 15%. then 16% again is what is normal. But the higher the internal rate of return, the more the advantage. So project N is recommended because it has shorter payback period and the higher NPV is greater than 0 and the larger IRR is greater than the 14% cost of capital. But if you see your project, now the IRR is 13% for that project. It's a dangerous project because how are you going to pay the interest for the return? Because you pay the cost of capital from the returns which you are going to get from that project. So IRR is yield for both project M and N, but N has got an advantage that it's got a higher what project. So you need to explain that when you are given a question to say which project to take. So you need to consider and comment what is the advantage of payback period, what is the advantage of NPV, what is the advantage of IRR, and so on. Any question? Any question?
This is crystal clear, Doc.
Right, thank you. We are trying to run against the time and you know the problem of Zimbabwe of electricity sometimes and network. So for us to try to move so that at least we try to cover as many things as possible. Let's look on the next question here. You can read for us this question. Any reader? Any reader here? Any volunteer?
Okay, Doc.
Yes, thank you.
Machira division is considering 2 investment projects, each of which requires an upfront expenditure of 25 million. You estimate that the cost of capital is 10% and that the investments will produce the following after tax cash. After tax cash flows. That's after tax cash flows, that's in millions of dollars. We've got here, then project A, then project B. Then we have project A, $5 million for year 1, for year 2, 10 million, for year 3, 15 million, for year 4, 20 million. Then project B, 20 million for year 1, year 2, 10 million, year 3, 8 million, year 4, 6 million. A, what is the regular payback period for each of the projects? B, what is the discounted payback period for each of the projects? C, if the projects are independent and the cost of capital is 10%, which project or projects should the firm undertake? D, if the 2 projects are mutually exclusive and the cost of capital is 5%, which project should the firm undertake? E, if the 2 projects are mutually exclusive and the cost of capital is 15%, which project should the firm undertake? F, what is the crossover rate?
Okay, thank you. Thank you for that. Thank you so much. Okay, here, this one, I think we've done. You go and do it. It's an exercise which you are going to do at the comfort of your home. So you follow the way we're doing there so that you understand this. The two projects are independent. We talked about it. If they are independent, what did we say? Discounted payback period. Discounted payback period. What we are saying, you should discount these funds. For example, if we came to this, what we're supposed to do, if there is discounted payback period, you say 11,00 times multiply by 0,8 something, 10 multiply by something, then you get the cash cumulative if they are discounted. So if it is discounted payback period, what we are saying if you discount this what cash inflows. Anyway, it's just an exercise which I want you to go and do so that you are to be able to do something at the comfort of your home. But I'll just explaining it. If they are independent, it means they can be taken at the same time. There's no need for what, but the cost of capital is 10%. Because this should be the same undertake. You only take if the funds are what available. Mutual exclusive. It means if the mutual exclusive, you only take one. The other one precludes the occurrence of another project. 15%, you go on and do that. That's just a practice. Anyway, let's go on to the cost of capital. This one, people, they will go and practice cost of capital. We're going to look on the source of capital, cost of each type funding, calculation of the weighted average cost of capital work, construction and this of the marginal cost of capital schedule. So we are saying cost of capital, it represents the cost of financing, like what I was explaining, to say that 14%, it represents the cost of financing. That's like the interest which is supposed to be paid to the lenders. Maybe if you get money from CBZ, you are supposed to pay some finance cost in form of what? Of interest. In particular, the cost of capital refers to the cost of the next dollar of financing necessary to finance a new investment opportunity. Investment with a rate of the value of profit return above the cost of capital increase the value of the firm. Like in the last question, whereby the internal rate of return was for one of the project is 15% and the other one 16%, but the cost of capital was 14%. So we're recommending to say this project they are good because the internal rate of return which is greater than the cost of capital, which means that the investors will go to get an additional return. So the project with the rate of return below the cost of capital will decrease fair value. We should understand that. That's why we're saying because our project has got 15% and 16%. So automatically it means we have the potential, the firm has got a potential to increase the firm's value. Yeah, I think we discussed on this in the previous chapter. Then the cost of capital is an extremely important financial concept. It acts as a major link between the firm's long-term investment decision and the worth of the firm's owners as determined by the market values of the shares. Financial managers are ethically bound to invest only in projects that they expect exceed the cost of capital. Cost of capital, that is 10%, retain 12%. So they can invest in such a project because the return is what is above the cost of capital. You cannot invest in a project whereby you are making a loss. It doesn't make any sense. Then the factors that are affecting the cost of capital, you should understand these ones. Maybe if we write an essay or a person, the general economic conditions affects interest rates, the market conditions. For example, the State Bank of Zimbabwe, they increased the interest rate to 200%. Now I think it's 150% per annum. They affect the cost of capital. It becomes very expensive. Like many industrialists and other business people were complaining that the cost of capital is too high at 200%. So it affects the cost of capital. The market conditions affect risk premiums. The risk premiums, what you want, the premium which you want to get after that, the market conditions is what is not it's volatile. Sometimes it might be volatile, what is fluctuation. Operating decisions affect business risk. The operating decisions we're talking about in how do we operate. Operating decisions affect business risk. The management plans running the business, financial decisions. What you want to do is that those funds are going to pay dividends, they're going to invest, they're going to do. It affects the cost of capital, amount of financing, affects flotation cost and market price of security. So they sometimes when it is high, it becomes more expensive and so on. So that is very critical to understand that. Let's go on to the next. There are 4 basic sources of long-term capital. The sources of long-term capital. 1, they've got long-term debts. These are debentures. Sometimes it can be 25 years or 20 years, depending on the amount on the agreement with the lenders. Preferred stock, cumulative and non-cumulative. Cumulative, we are saying you can, if you fail to get your dividend this year, you can get them when the dividends are there. Non-cumulative, you only get dividends when they are available. Common stock, ordinary share capital. These are the owners of the business, ourselves. That is what we call ordinary share capital. Retained earnings, that is the plowback profits which we have got, then we invest it into the business. That's the retained earnings. So usually when the company went into liquidation or the company is winding up, the last people to be paid are ordinary share. After paying the creditors long-term paid stock, then common stock, because these are the owners of the business. So you can do these questions, the few questions, what the cost of capital, role does the cost of capital play in the firm's long-term investment decision? What does the firm's capital structure represent? What are the typical sources? These are some of the questions which you are supposed to do at your comfort of your home. Then you go here. And before go further, any question on these theories? So that people, when they are reading at the comfort of their homes, it becomes easy for them. Let's go on the complete cost of debt. The required rate of return for creditors. Same cost found as due to maturity on bonds is KD. That is cost of what debt. Suppose that a company issued bonds with a poor tax cost of 10%. Since interest payments are tax deductible, the true cost of the debt is the after-tax cost. So we are saying a poor tax cost of 10%, but they are saying interest payments are tax deductible. They are not what? They are not taxed. They are allowed for tax. Sorry, they are not allowed. So if the company is the tax rate is 40%, the after tax cost of debt is 10%, 1 minus 4. That is 6%. 1 minus 4, 1 minus 0.4 here. we are saying that is the on its own, we understand that we have got a situation whereby the tax rate is 40%, but all in all should have a 1 or let's say I say 1 minus 0.4 here. Minus 0.4 then becomes 0.6. 10% of multiplied by 0.6. 10% of this one, then it becomes 6%, then after tax debt. So we need to be very careful on this one. Say, because what we are saying, the rule says, these are rules that interest payments are tax deductible. If you pay an interest, these are tax what deductible. So because this cost of capital which you are going to pay of tax cost 10%. 10% it's a what? 10% is an interest. 10% is what? Interest. But the company's tax rate is what? 40%. The 40% here. So which means that after tax is what? 6%. Because we are removing the element of what? We are removing the 100% in full. Then if it is 40% tax rate, the remaining, that is, it means we are supposed to make sure that we've got 6% at the cost of debt. Then cost to raise a dollar preferred stock here, that is dividends, market price here, dividend, market price. Market price, that is the price, that is a willing buyer and a willing seller. Usually market price determined when it's got at a fair value, the market price in the which is there, which is available. For example, the market price might be different from the book price. Why? Because the market price, it depends on the market condition. You can overvalue your assets, can overvalue your firm. The firm can be have a market price of 2 million, but while list on your books you've got 5 million. Or sometimes they can be close to each other. So dividend, that is the amount which can be what paid to the investors at the end of the day. So you can each pay stock for a net price of $42, and the paid stock pays a $5 dividend. The cost of preferred stock is 5/42. $5, that's the dividend which is going to be paid. Dividend, that is the amount which you are receiving from the profit, which you are receiving, which is received by people who invested their money as a part of profits. Then the stock price is 42, so it means the cost of preferred is 5/42. That is 11.90. Then two types of common equity financing: retained earnings, internal common equity. Issuing new shares, common equity, external common equity. If it is our own, we don't have what? This is not expensive because we are paying from our own what? Our own money. Then here you've got the cost of internal of common equity. Management should retain earnings only if they earn as much stockholders' next best investment opportunity of the same risk. Cost of internal equity is equal to opportunity cost of common stakeholder funds. Two methods to determine: you've got dividend growth model and capital pricing model. That is common stock equity. That is D1 dividend for A1 period. PO price at 0 plus G is growth rate. So when you are saying K is cost of what? Of the capital. So cost of the stock equity. So D1 dividend. paid. Then PO, that is the price. Then market price plus G, that's the growth rate. For example, the market price of the share of common stock is 60 here. You've got 60 here, that is the common price, that is the 60, that is the market price which is supposed to be here. The dividend just paid is 3, so it's 3 over 60 plus, and the expected growth rate is 10%, that is 10. So this over this plus 10, so it becomes 3 over 60 plus 10%, which is here. What we are saying. So the market price of the share of common stock is 60. The dividend just paid is $3, and the said growth rate is 10%. Then you go here. That is cost of capital. Dividend D1. That is for year 1. So D for year 1. That is dividend just paid. That is 3 into then is 0.10 expected growth rate. That is the growth rate of 10%. Then PO, the price, what, 6%. So you need to have to know these formulas. Usually I given the formula book, but don't worry. We usually don't give you as much as the examiner usually don't give you as much calculation as possible. But you just need to understand what we mean by this, so that your company won't face some problems. What is key important is to explain at master's level. But the undergraduate is where we expect people to give some heavy calculations. But at this level, we don't expect that. We just trying to make people they understand what does this mean. Analysis, that is key. So we can use the capital, the cost of what? Cost of capital. That you can use this formula. Is there in your module? Again, to compute the common equity, whether we have got a risk premium, market risk, and risk premium here. Let me move to what we want to do together, so that at least you understand. If you got a person, so that at least some of my friends will understand what we mean. Like what I said, these formulas might be a very big problem. Let me go on to the question. If you do a question, then you can be able to understand. Come here and give the question. Yeah. This one, I think. Okay. Let's go to this one, so that if we use numbers, then we apply, people they can understand what we mean by the market value or book value weights. Okay. What we are saying, a company on its own, a firm, cannot be financed itself. It's very difficult. Sometimes there is a time whereby the company can borrow also. So the company can have many sources. Can have equity share capital, that is where its own funds, retained earnings, that is the profit which has been generated maybe over a particular period. Preferred share capital again, then debentures. Then what they wanted to do, sometimes they can want you to calculate the book value weights and the market value weights. I say the book value weight, that's what we have as a company. to say we can argue that our company values 20 million in our books, but the market value, they can say, no, it is not 20 million, maybe it's 20 billion, depending. So the book value, that is our own, for our own as a company, but market value, that is the amount which you can want, the consideration which can be paid by the willing buyer or outside there. So this company has got this company has got let's say here the equity share capital $10 per share, that is 45,000. I'm the one who was working this one last period. Then the retained earnings. So book value is 45. The book value is 45 and the market value is 90,000. Then the retained earnings is 15,000 here. But the market value cannot have a retained value, a retained earnings for market value. The capital, here we've got what? 10,000, market value 10,000. Then the debentures is 30,000, then the market value 30,000. So what we do here, if you want to find out the weight of each source, we start by 18, 45 plus 15 plus 10 plus 30, then you get 100,000. Then you say 45 by 100,000, then you get the what? The weight. 15,000 divided by 100,000, 10,000 divided by 100,000. Want to find out how much percentage or what proportion does a certain source of finance represent in the entity. We can also go to market value here, 90 plus 10 plus 30, so 130,000. So if you want the percentage of equity share capital, that is 90 plus 90 over 130, 18 over 130, 30 over 130. By doing this, we are calculating the what? We are calculating the weight for each. Say 45 over 100. I mean that is 0.45. This one 0.15. This one 0.10. This one 0.3. Those are the weights. To say, so our company is highly geared or is not highly geared. So if your company is got ventures more than 50%, say if borrowed so much, then you can say your company is highly geared. Okay. So equity share capital here, you find out that the after tax contribution source of finance is as follows. This one 14, 13, 10, 5%. That is the after tax cost of principal finance is as follows. Here we're saying 45 divided by 100,000 by 100,000, 15,000 divided by 100, 10,000 divided by 30, and so on. Then at the end of the day, the equity share capital, source of finance, debentures 5% preference. So here, if we work on our own here, in the market value, for example, the first one on the market value, if you calculate 90 divided by 130, 90 divided by 130, this one is okay. Then you go on to the next one, 10 divided by 130. So it becomes a highly geared company. When you find out that the company is largely financed by debentures, but on this company, value debentures, they are what? They are relatively low. They are not that much, which is very highly commended. I think it's 23%. It's 23 what percent. Don't worry about these ones. Then let's go on to the question which we want to look. Okay, this one, that's what we're doing here. To say when we're calculating here, I was saying 90 divided by 130. Let's start by book value weight. The book value weight was 45 divided by 100,000, which is what? 0.45. Then retained earnings was 50 divided by 100,000. We are not given 100,000 in the examination, or anyway. You should calculate on your own by just adding the values. Then you get what your denominator. So you add this one. Then after tax, we are given this additional information here. They are saying the after tax cost of differences of finance is as follows. So equity share capital is 14%, then retained earning 13%, parent share capital 10%, debentures 5%. So what do? Then these are the proportions. So you say the proportion times after tax, which is 3 times 4 to get the weighted cost. So here it's the 0.45 times 14%, which is 0.14. You get this. Then 0.15 times 0.13, get 1.95. Then 0.10. These ones you are given. This is given here. You are given the after tax what cost. If it was before tax cost, we're going to adjust. But anyway, it's so straightforward. Then after that, you work to this point. The same again to the market value. You do after tax again 14, 10, 5. The proportions here, like what I said, the first one is 0.692, 90 over 130, 10 over 130, and so on. Then you get here again. So the cost of weighted cost is 10.75% at the weight, which means that we are saying our cost of capital or providing the capital is 10.75% using the book value. But we cannot do this unless, because this is 14% times the proportion, 13% times the proportion, 10% times the proportion, 5% times the proportion. Then after we get this, then we add together. Then we get 10.75. Because we cannot say 6.3, we cannot say 6.30 multiplied by everything, but it's related to this one. Then you go to the next one, 9.68, 9.77, the same like here again. So we find out that the work is very high on market value. It's 11.613%, but on book value is 10.75%. That is what's supposed to do. So we go on to the next one. Let's look on this question where this is an exercise we're supposed to do. So say companies compile the information shown in the following. I hope people they will go and work out on this. Calculate the weighted average cost of capital using book value weight. Calculate the weighted average cost of using market value weights. Compare the answer obtained part A and B. We will do the same thing like what we did here. Say 4,000 over 5.1, 4 over 5.1. Then the answer which you get 1 over 5.1. So the first one, 4 over 5.1 times 6% for long term. 4 over 5.100. The answer which you get times 13. 1.06 over 5.1 times 17. This also applies market value. So that's why I was putting exercises so that at least you practice this. The slides is easier to follow sometimes than the module. Any question before we go further? Any question before we go further? Any question? Any question? Any question? Hello, colleagues. Hello.
Hello, yes, we are following. I think you can proceed.
Okay, who can read this question? People, they should listen carefully to this question. Need to pay attention to this question. Who can read for us? DEB.
Okay. DEB Private Limited Company is a listed company that sells fashion clothes over the internet. Financial markets have criticized the company recently because of the high levels of debt that it has maintained in its balance sheet. The company's debt consists of 150 million of 8% debentures that are due for repayment by 31 March 2005. Financial markets indicate it would not be possible to issue a new loan under the same conditions. The market value of the debentures is $90 per $100 nominal. DEB Private Limited draft balance sheet at 31 March 2002 was as follows. Ordinary shares of $1, 100 million, reserves 20 million, giving us a total of 120. 8% debentures at nominal value, 150 million. That's giving us a total of 270. That is 120 plus 150. Fixed assets, 200 million. Net current assets, 70 million. Give us a total of 270. I think that's the question, eh?
You've done.
Yeah.
Not yet.
Or not yet. Fixed assets consist of 150 million of capitalized development costs and 50 million of land and buildings. The company's share price has fallen constantly over the past 2 years as follows. Price per share, 31 March 2000 was $20. 31 March 2001 was $8. 31 March 2002 was $4. The company intends to make a 1-for-2 rights issue at an issue price of $2.50 on 30 June 2002. It is assuming that the cum rights price at the issue date will be $4. Immediately thereafter, all the proceeds will be used to redeem debt at its nominal value and thereby reduce its gearing. Requirements. A, calculate the gearing, that is debt over equity, of DEB PLC at 31 March 2002 using both 1. Book values, 2. Market values. B. Evaluate the weaknesses and the benefits of the two methods used to calculate gearing and requirement A above. C. Calculate the gearing of DEB PLC in market value terms immediately after the rights issue and the redemption of debt. D. Briefly explain the advantages and disadvantages of DEB Private Limited Company of redeeming part of its debt using an issue of equity shares. Total 25 marks.
Okay, thank you so much. So Mark, so the gearing, like what we were saying, the gearing, we are saying the debt over equity. So you calculate the debt which you want is our interest bearing debt. Then equity, we are talking about our what? Our finances, the finance of the company, which is ordinary share capital plus retained earnings. So at book value and market value, since you are given the two what? The two items. Okay. So if you look here, they are saying the company debt consists of 150 million of 8%. That is the debt. The market value of the debenture is 90 per 100 million. So it's 90 over 100 times 150. $90 per 100 nominal. So it's 90 over 100 times 150. That's the market value. Because the book value is 150, but our market value is 90 over 150. Then this one is given straight. That's the reserve. Reserves are part of like retained earnings, they are part of us. So if you are going to the question, calculate the question 1, they are saying they need a book value. I said 120. 120, I said you need to say that is we are given a formula here. They are clearly giving me a formula. That is 150 over 120 for the debentures has 150 value. And our reserves, the shareholders equity. Shareholders equity consists of ordinary share capital plus reserves. Reserves such as retained earnings and so on. So pick that is 120 over 150 because that is a given figure. 150 over 100, sorry, they gave us. So that's the book what on the big values. But on the market values, I say we are no longer using 150. 150 is not our market value. We say 90 because there is a clause which is saying the clause says that is 90 per 100 nominal. So it's 90 over 100 times 150. That's the market value. It means for what we are holding $800 on nominal party, the market value is 90. So you get 135 on this one. You need to understand this one carefully. You need to listen carefully on, be very careful on this one, which is 90 over 100. That is 0.9 multiplied by 150. You get $135. I think you understand how do we get $135. Then on the market value for ourselves. They are saying we'll now look at the clause of our equity. What does it say? The clause of our equity. They are saying the price per share 31 March was $20. 31 March 2001 was $8. 31 March 2002 was $4. Those were the price per share. Then we went on and look for the purpose of the current one. This is the current one. The current one, that is we have got 31 March 21. You need to check the dates. Dates are critical. 31 March 2022. So what you do, you go and pick. We have got $100 ordinary shares is 100 million. So it's 100 divided by 1. So it means our number of shares. Calculate the number of shares first. That is 100 million divided by 1. So we've got 100 shares. Remember, on the previous lesson, on the market value, we don't have reserves and retained earnings, but we include the number of of shares. So it's 100. Then 100, you come here and you pick the value at 31 March 2002. The value was $4. Then you say 4 times 100 million. It becomes 4,000. That's why here we've got 400. Because the market price per share for each is $4 as a 31 March. Because we are saying the question says as a 31 March 2002. So we pick the value as a 31 March 2002, which is $4. So we say $4 multiplied by the number of shares, which is 100. That's 400. This is 400. So it's 135 over 100. You need to be very careful. 33.75%. Then weakness and benefits. Measuring gearing using book value says that advantage that it will not fluctuate widely as the stock market rise and fall, but will be much more closely aligned with the company's historical performance. For this reason, banks and other lenders who have gearing covenants usually base the ratio on book values. However, measuring gearing using market values allow the equity to reflect the market expectations of future performance through the share price. This is particularly beneficial when much of the equity value is tied up in intangible assets, such as staff and reputation in a service company, which are not reflected in the balance sheet. So here, when you are doing market values, we don't add, please don't add the retained earnings and reserves. Just take the number of ordinary share capital times the value on the market. On this case, for 400, it was 100 times 4. So here we are talking to say it will not fluctuate widely. Then let's go on the calculation of X rise. The X rise here, because what we are saying, remember, we are saying the company intends to make a 1-for-2 rights issue at an each price of $50 on 30 June 2002, which means that 1 for every 2, 1 for every what? For every 2. Okay, sorry, let me under the Okay, sorry, it was a call. Okay, the company is $1 for 2 rights and it. So which means that we are saying for every two which you have going to give in one. That's what it means. So it means I'm going to have original, it's 2 times 4 plus 1 times $2.50. Now I now have how many shares? 3 shares. Because I've got original, I've got 2 times 250. I want to weigh plus 1. Originally, I have got 2 times $4. Then now, in those ones, it's 1 times 250. So it's 2 times 4 plus 1 times 250 divided by 3. Because I now have 3. 2 original, which I have, plus 1 the other one. So I now have 3 here. That's why I have got a denominator of 3 here. So the extract price, manje, what's the price I'm now weighing? 2, which original I have, the market value was 4. Then 2 per 1 given is now $2.50 times 1 divided by 3. Then I get $3 what? $3.50. Yeah. Then it becomes what? $3 what? 50. Okay. Then after that, then on the debt, I'll go again to the debt, which I'm supposed to find out the issue of debt, the close of debt. What do they say about the debt? Let me find out here. This is about the shares. Then on debt, they are saying these were 150 million of 8% venture that are due for repayment by 31 March 2005. Financial markets indicate it would not be possible to issue a new loan under the same conditions. The market value of the debentures is $90 per 100 watt. The DEB draft balance sheet is as follows. This was the draft balance. It was 150. Then go on to the next one. We want to find out. The question says calculate the market value terms right after the right issue and the redemption of debt. And so after the right issue, that's why we calculated there. We find out that our share is changed. Then after the right issue and redemption of debt. When you are redeeming, it means you are buying back. After buying back, it is assumed that the cum right price of the issue debt will be $4. Immediately, after all the proceeds will be used to this, but all the proceeds will be used to redeem debts at its nominal value. If you are redeeming, you are buying back. So what do we mean? All those proceeds, how many shares are going to be there? That is 1/2 times 100, which are there. Because originally, in our balance here, we have got 100 million shares. So 1/2, that is half of 100 million, which is 50,000. So they are saying these 50,000 shares from this one, it is that the cum right price at the issue date will be $4. Immediately thereafter, all the proceeds will be used to redeem debt at its nominal value. So that is 50. So it means here we are supposing to buy back from the proceeds. So 50 million, which we are saying, because we are saying all the proceeds, the $2.50 was the what? the value $2.50 here times 50 million. Where do you get 50 million? 50, it's 50 million, it's half of 100 because it's 1:2, which means that for every 2 holes, you are going to get 1. So it's half of 100, that is 50 million. Because of that, 50 times $2.50, because our debt was 150 at the beginning, then minus $2.50 times 50 million. So it means we have now 25 million net nominal value. Are we together? How to get the remaining debt? Because if you are redeeming, you are buying back. So it means they buy back those ones. But it was 1:2, which means that 1:2, half of ordinary say were 50 million. 50 million times the what? The price here of $2.50, the extra price, minus 150 here. 150 is supreme because that we originally we 150 million the debt, but it's going to be reduced because they want to reduce the number of debts. That's $2.50 on the market value. $2.50 times 50 million, then you get 25 million. So now you have 25 million at nominal value. 25 million, but at market value it's 0.9. How do you get 0.9? Because 25 million multiplied by 90 over 100. That is what is 0.9. Then 1/5 multiplied by, this is now for what? The new gearing level times $3 what? $3.50. This is $3.50 X right price. Then you get 4.29. Anyway, as you go, you try to practice, but I think I have explained this. How do you come up with this $3.50? Because we have said already, originally, we have got what? 2 shares. 2 shares, they were costing times $4 each, plus the additional 1:2, that is 1, which is costing $2.50 times 1. How many shares do we have now? 3. 3, we are getting 3 because it's 2 plus 1. Then you've got 3 because we've got 2 additional plus 1, that's 3 total ratio. That's $3.50. That is the X right what? Price. That is the X what? X right price. At $3 what? $3.50. That's why they wanted the new gearing what ratio. Because 150, how do you get 150? Because we have redeemed, we have buying back some debentures using shares. Originally we've got 100 plus 50, which we have got. That's why we've got 150 times $3.50 here. Here they have now been reduced, now 25 times 0.90. And 0.90 is our what? Market price, which we are given there. Then we get 4.29. Any question? As you go and practice, please practice this person. Please make sure that you practice this person. Calculate when you are okay. Briefly explain advantage and disadvantage of DEP, redeeming part of its debt using an issue of shares. That's the last part which you want. Advantage and disadvantages. The new equity will reduce debt levels. If you reduce debt levels, it means they are not going to pay interest. The rate of interest is going to be lowered again. Debt confidence may be based on book values for gearing calculations, and repayment of much the debt will prevent any breach of this. Yeah, it's correct. Because if you breach the contract of not paying, it becomes a big problem. The cost of debt may decrease as the 50 million of land and property now cover the remaining debt comfortably, and gives it's now covered by the what? By those assets. So we expect you to explain this to say, because once you decrease those debts, you now have a what? A big advantage, because this now covered by what? By land and other what? Because land is like a security, what becomes a big advantage. Then advantage is again the new equity will reduce the debt levels. We've done this. the cost of debt may decrease. Disadvantages: the market, in market value term, the gearing was not particularly high, and the new equity will have a higher cost than the debt repaid, despite it being lower than the current cost of equity because the reduced gearing risk. Under the traditional model, it is difficult to predict if the WACC would increase or decrease. Under the theoretical model, the WACC would increase as the gearing reduced. As the market price is below par, this is currently a cheap source of finance, and paying off over 80% appears excessive. Okay, so that is our last part for today. Any questions?
Yes.
Yes, you can continue.
Maybe just to take you back to
Yeah.
capital budgeting.
Yes.
It's like I've heard people interchangeably using investment appraisal or capital budgeting. Is there any difference between the two? Then the second part, still on capital budgeting. The example that we've done today had an initial investment, just one figure, but I've seen some other scenarios where there is working capital which is required for the project to be undertaken. My question is, I would want to know, how do we treat the working capital element that is required for the project to go ahead? That's my submission.
Okay, the issue of working capital included in the cost of projects. What you are asking?
Yes.
Okay, it depends. Sometimes they will be given a clause to say the working capital will be, but generally in most of the situation, the working of capital usually we don't include it most of the time. But depending on the question, sometimes because the examiner might give you to say how do we treat those costs of capital in those projects. Like what you are saying, say some person they will give you to say there is one additional cost of working capital. Sometimes that working capital might have an effect on the net present value. If you look like you 1 grain, yeah, the by 1 grain, if you have got a question similar to that, whereby the cost of capital, the working capital will also reducing the NPV over that particular period. Then what we are saying to say, usually it might be very subjective, because some find out some authors they make sure that working capital reduces the cash inflows. You read 1 grain, the other book I'm not understanding about Gitman. But what you should understand at this level is that when you're making decisions, because some of the working capital again, they might be covered up, or they might be compensated by the revenues which are coming from other additional from additional sources of income in that organization. Hello. Hello?
Yes.
Find
yes.
out that, for example, from your question, you find out that maybe we've invested in long-term project, like a machinery. Might need to find the figures, the cash flows which are getting there. That is the cash which is being produced by the what? By the organization or that particular project. Sometimes you can get a net figure over that particular period. Hello, are we together?
Yes, we are following. Maybe I can rephrase.
So that's why you find out that that's where we discount. Because when you are discounting, usually you are using the discount values. We have got many things there. We have got like interest here. When you are discounting, we reduce that value and it, because these are additional what short-term investments to be recouped later. That's why we are discounting. Like interest, we say it was because of the cost of capital. If we received 5,000, then we say we go on to the what, to that interest. That is the cost of capital. Our figure will be reduced because of discounted what effect. So which means that we are saying our NPV usually should include the discounted value of changes in working capital. That is the idea. So we are saying usually sometimes we can say like what I said. If you look at that book like which was written by one grain and working capital was included in the calculation of net present value of a company. It was included. Hello.
Yep. Hello. Then if some textbooks, some authors are including working capital figures in the computation of NPV, and some are excluding, then what is your recommendation? Should we include or should we exclude for the purposes of this course?
Yeah, what we need to do, and working capital is included when calculating net present value. So usually you need to calculate and the company's current assets and its what current liabilities. So that is the working capital. So working capital should be what included. That's included. But I don't think you can have such a complex question, because we are talking about some people who are from engineering, some people who are from chemistry. There are people who have never done finance or accounts at all. So usually we don't the examiner won't try to make people suffering. But what you need to understand is that the working capital is what is included when calculating net present value.
Understood. Thank you.
Thank you so much for raising that. That working capital is included. Any other questions? I'll share this with you. So please read this PowerPoint. Don't ignore it, because you'll be found wanting in the examination sometimes. Then you say it's not there in the module, because sometimes not even attend the tutorials, and you never read. So I'll share with you this. Then I will do my best to download the download the video, this video, I'll try to make sure that this video has been downloaded to everyone.